Hello trading friends and welcome back to Forex Focus, brought to you by IG. Taking a look at the strongest non-farm payrolls in 10 months, its effect on US interest rates, as well as some US dollar we'll throw in there for good measure. But we'll go deep on not only treasury yields, but as well as the Fed funds rate and where the market is projecting the Fed to be moving rates in light of this strong employment data that came out here in early April reflecting March's market. Let's dive into it. The March non-farm payrolls change was positive. Not only was it a positive, it was 303,000 jobs added in March. The expectation was 200,000, so a huge beat here in March. And now this has been the trend for the last few data points here. You might remember that the non-farm payrolls that came out in January for December was hot. The one that came out in February for January was hot. And the most recent March for February also hot. But another trend has been they've all, for the most part, been revised down after the fact. Still strong numbers. I mean, you can see the 250 to 300 range is really strong. Normally, you take out these huge numbers that we've been seeing recently, normally you're seeing 150 to 200, and the expectation at 200 here this month was still pretty high. So a lot of strong data, even if this 303,000 number gets revised down to 250, 260, whatever, that's still stronger than expected. So this is all to say strong U.S. data on the employment front. And this has been happening as U.S. inflation has continued to edge lower. Is it where the central bank wants it at 2%? Not yet, but it's been edging lower. Interest rates have remained high from the Fed. And really, the central bank here in the U.S. getting the best of both worlds, which is that dropping inflation and continued good U.S. data otherwise. But let's dive into interest rates. We're going to start with the Treasury yield, and then we'll go into what the Fed controls and the projections around it for the remainder of the year in just a second. But U.S. Treasury yields and U.S. interest rates in general found this news quite well. 10 years right back at highs going back to November, near 4.4%. And the question becomes now, will interest rates be higher than previously expected for longer than expected? You might say, well, 10 years, that's a long friggin' time. Yes, it absolutely is. And the fact that 10-year yields are back to 4.4% doesn't give a lot of leeway for the Fed's overnight rate, which is all the way up at 5.25% to 5.5%. So some leeway, but not necessarily as much leeway as previously expected when the 10-year was down under 4% at the end of 2023. Now let's actually look at projections for the Fed funds rate at the end of 2023. You could see that there was a more than 50% chance of sub 4% interest rates at the end of 2023. Now let me dissect that for a second, because we highlighted here the projections on December 29th of 2023. And if you zoom in and you take a look, you'll see, but also I'll paint the picture for you here right now. There was a more than 50% chance, the market thought at the end of 2023, that the Fed would cut interest rates, not only cut them in 2024, but cut them all the way down to below 4%. Well, it's now April. The Fed hasn't cut at all. Interest rates are still 5.25% to 5.5%. And now the chances that they get to 4% or lower interest rates by the end of the year, zero. The market is pricing in a 0% chance now that the Fed would cut all the way down below 4%, because that would be, at this point, 150 basis points of cuts for essentially half the year that's left. Only, I believe, about 5 Fed meetings for the remainder of the year. And so 150 basis points in 5 meetings, that would mean that each of them, they'd have to cut at least 25 basis points, or they'd have to have a couple of meetings of 50 or 75 basis point cuts, which I don't think they want to do. Fed Chair Powell recently has said that they're not really in a rush to cut rates, especially because this data continues to come in hot. So they're going to watch inflation, and it seems like they might watch it go all the way down to 2% before they cut rates. That remains to be seen, but we do know that projections are definitely moving away from Fed rate cuts. And let's look at the current environment for the end of the year here. Here you have the probability curve as of right after this non-farm payrolls came out. And you can see a couple of things. One, the focus of the curve is right around 4.5% to 5%, with that 33% block in the 4.5% range, and that 29% block right around the 4.75 to 5% range. And so right now, that would only be about 50 basis points to 75 basis points lower. The way that the Fed has been changing rates primarily in recent years, that would be 2 to 3 rate cuts. Going into the year, like we just looked at, the Fed was looking at around 150 basis points. Effectively 6 rate cuts, now down to only 2 or 3. And on top of that, it's not the biggest chance in the world, but it is there and it's been growing. The chance of no cuts in 2024, which of course would have huge effects on stocks, on gold, on everything on down the line. Of course, forex as well, which we'll touch in just a second. But now up to a 2% chance that rates stay unchanged throughout the remainder of 2024. You might say, Frank, 2%, I mean, that's a rounding error off of 0. Yeah, it's quite close to 0, but it was 0 a couple of months ago, and it's gone to 1% and now 2%. And the way that you've seen this curve shift from focusing around 6 rate cuts to now around 2 or 3, you keep going in this direction, and very quickly it could focus around 1 or no cuts if we have similar U.S. data coming out for the next several months. And by similar U.S. data, I mean strong employment, strong GDP, and sticky inflation around 2.5% to 3.5%. We'll see where all the data goes, but for the moment you have interest rates rising in the U.S. In terms of Treasury yields. You have interest rate projections from the Fed moving closer and closer to unchanged to only a couple of rate cuts. And you have a U.S. dollar that is remaining strong. Now, off of the number, it saw a ton of strength and then reversed a lot of it. So dollar not necessarily at its highs, but it's pretty close to highs as USD is within 100 pips or so of year-to-date highs versus the euro, versus the pound, versus the Swiss franc, and the Japanese yen, of course. They're up close to 152, and versus the Japanese yen, that's approximately 30-year highs for the US dollar. And take a look at that dollar versus the franc as well. That's a market back above 90 cents that has had a huge rebound here in 2024 as the Swiss central bank has actually already cut interest rates. And so that's been a really interesting forex pair. And then, of course, euro around 108. It's had some flashes below 108. We'll see if they try to take that market down to recent lows around 105. And then under the radar, because it's been so strong, it's been one of the strongest major currencies against dollar in recent years, that pound has traded under 126 a couple of times in recent trade. And keep in mind that 125 is kind of the low for pound, high for dollar, obviously, in the last several months. And so that's one that is starting to look more and more vulnerable. Now, of course, all of these markets, that euro's been up above 110, that pound has been up above 130, that dollar Swiss franc has been down below 87, 88. And so these markets can just as quickly move in the opposite direction. But US dollar still holding on to a lot of strength here in 2024. And after the non-farm number that came out, saw a ton of strength, reversed some of it. But we'll see how the market digests all of this information in the coming weeks. We'll have more inflation data coming out of the U.S. We'll have another Fed meeting before we know it. For the time being, continued trend of strong U.S. data, strong U.S. rates, and a relatively strong U.S. dollar. We'll see where it goes from here.